In the intricate dance of global economics, central banks, policymakers, and investors find themselves navigating an increasingly complex landscape. The past week has brought a flurry of economic data and speculation, leaving market watchers and ordinary citizens alike pondering the future of interest rates, inflation, and economic growth. As we stand at this critical juncture, it's worth examining the various factors at play and their potential implications for economies around the world. The European Central Bank, ECB, finds itself at a crossroads, with investors confident of an imminent interest rate cut. The swaps market has fully priced in a reduction to 3.5% at the upcoming meeting, a significant shift from the record high of 4% set in June. This expectation comes on the heels of a sharp decline in inflation, which hit a two-year low of 2.2% in August. However, the path forward is not without its complications. Services inflation in the Eurozone ticked up to 4.2%, a development that some economists attribute to the effect of the Paris Olympics. This uptick presents a conundrum for the ECB: how to balance the need for economic stimulus with the risk of reigniting inflationary pressures. Karsten Brzeski, global head of macro at ING, encapsulates the prevailing sentiment. With the latest inflation data out of the Eurozone, a rate cut at next week's European Central Bank meeting has almost become a done deal. This confidence stems from the fact that headline inflation is approaching the ECB's 2% target, while longer-term inflation forecasts remain stable around the same mark. The ECB's chief economist, Philip Lane, has hinted at the likelihood of further rate reductions, warning against keeping rates too high for too long. This stance reflects a growing concern among policymakers about the risks of overshooting and potentially stifling economic growth. As the ECB prepares to make its announcement, market participants will be parsing every word for clues about future policy direction. The current split in expectations regarding an October rate cut underscores the uncertainty surrounding the economic outlook and the challenges facing central bankers as they attempt to chart a course through turbulent waters. Across the Atlantic, the United States faces its own set of economic puzzles. The recent jobs report provided a mixed picture, with employers adding more jobs than expected but at a pace that still indicates a cooling labor market. This ambiguity has shifted market expectations towards a more modest quarter-point interest rate cut at the Federal Reserve's next meeting. All eyes now turn to the upcoming Consumer Price Index, CPI data, which could provide crucial insights into the Fed's next moves. Analysts expect the headline CPI to show a decline to 2.6%, potentially marking the first time it has fallen below 3% since March 2021. The core CPI, which excludes volatile food and energy prices, is anticipated to hold steady at 3.2% year-over-year. James Knightley, chief international economist at ING, suggests that a monthly core CPI print of 0.2% would give the Fed free range to do whatever they want. This flexibility could translate into a more aggressive half-point rate cut, a move that would have significant implications for borrowers, savers, and investors alike. The interplay between inflation data and labor market metrics presents a complex picture for Fed policymakers. On one hand, signs of cooling inflation provide room for monetary easing. On the other, a resilient job market could stoke fears of wage-driven inflationary pressures, potentially staying the Fed's hand. In the United Kingdom, the focus shifts to wage growth data, a critical indicator of inflationary pressures and economic health. Recent labor market data has sent conflicting signals, with a falling unemployment rate suggesting a tightening labor market, while slowing wage growth points to easing pressures. The Bank of England's decision-maker panel, which surveys chief financial officers, revealed that wage growth expectations for the coming year remain stuck at 4.1%. This stagnation in expectations presents a challenge for policymakers aiming to bring inflation under control without stifling economic growth. Ellie Henderson, an economist at Investec, offers a more optimistic outlook, forecasting a decline in regular pay growth to 5.1% in the 3 months to July. This potential easing in wage pressures could provide some relief to the Bank of England as it navigates the delicate balance between supporting the economy and controlling inflation. The wage data also carries implications beyond monetary policy. The UK's triple lock pension pledge means that state pension payments rise each year by either 2.5%, inflation, or wage growth, whichever is highest. The upcoming figures will play a crucial role in determining pension increases for the 2025 to 26 fiscal year, highlighting the far-reaching effects of economic indicators on citizens' daily lives. As we examine these economic developments across Europe, the United States, and the United Kingdom, it becomes clear that the global economy is more interconnected than ever. Decisions made by one central bank ripple across borders, influencing currency values, trade flows, and investment patterns worldwide. The divergence in economic conditions and policy approaches among major economies presents both challenges and opportunities. For multinational corporations, navigating this landscape requires a nuanced understanding of regional variations and the ability to adapt quickly to changing circumstances. Investors, too, must remain vigilant, balancing the potential for growth in some markets against the risks of volatility in others. The current environment of uncertainty surrounding interest rates and inflation trajectories demands a flexible and diversified approach to portfolio management. For ordinary citizens, the implications of these economic machinations may seem abstract, but they have real-world consequences. Changes in interest rates affect mortgage payments, savings account yields, and the overall cost of borrowing. Shifts in inflation rates impact purchasing power and the real value of wages and savings. As we look to the future, several key questions emerge. 1. How will central banks navigate the fine line between supporting economic growth and controlling inflation? 2. What impact will geopolitical tensions and trade disputes have on global economic stability? 3. How will technological advancements and the transition to a greener economy influence traditional economic metrics and policy tools? 4. Can policymakers address growing income inequality and ensure that economic gains are more evenly distributed? 5. How will demographic shifts, such as aging populations in developed economies, shape long-term economic trajectories? These questions have no easy answers, but they underscore the complexity of the challenges facing policymakers, business leaders, and citizens alike. As we move forward, it will be crucial to foster open dialogue, embrace innovative solutions, and remain adaptable in the face of an ever-changing economic landscape. In conclusion, the coming weeks and months promise to be a critical period for the global economy. The decisions made by central banks, the data revealed by economic indicators, and the responses of markets and consumers will shape the economic narrative for years to come. As we navigate these uncertain waters, one thing remains clear. The need for informed, thoughtful analysis and decision-making has never been greater. For those of us observing and participating in this economic drama, whether as professionals in the financial sector or as engaged citizens, the task ahead is to remain vigilant, continue learning, and contribute to constructive discussions about our shared economic future. Only through collective effort and understanding can we hope to build a more resilient, equitable, and prosperous global economy for generations to come.